Hello, everyone. Welcome to another video of Haugen Patel Value Investing. As always, my name is Lars Christian Haugen. I'm here with Roshni Patel. And as always, it would be great if you can like the video, subscribe, also comment. We actually had quite a lot of comments on our other video, which is quite nice to engage with people. Also, check out our website, which is hpvalueinvesting.com. And also check out our eToro page, which is a social trading platform where you can copy our investments, or if not, you can just follow us and just see what we do.
So what's this video about? We're doing this new video because the full year 2021 results for ASOS came out last week and the market was quite disappointed. The CEO had left and the share price had tanked. We invested in ASOS back in September of this year at £38 and we'd published a video about it too. So the question to answer here is, what are we going to do now? And now the next section, which is the full year 2021 results. So in short, the results were actually quite good. If you look at the revenues, you'll see that they were up around 20%. Gross profit was up 15%, but the gross margin had declined. And this is in part due to higher freight costs and Brexit-related duty costs. When you look at freight, costs per container from Asia to Europe had gone up from $2,000 to $14,000 in the space of a year. Now, ASOS produces a lot of their pieces in Asia, so this will have had an impact. This is an industry-wide impact, though. And as for Brexit, these costs would be due to ASOS shipping some of their goods between the UK and EU. And ASOS had partially offset this Brexit impact through investing back in 2019 in their Berlin warehouse, which is in the EU. And now when you look at the net profit, that's up 13%. Not great, but it's not terrible either. And then finally, the earnings per share were flat because ASOS had issued more shares over the year. And so the problem really is when the CEO abruptly leaves the company. There's no replacement at the moment. And for us, this is a bit of a bad sign. The full year 2022 outlook doesn't look that great either. Now, the sales growth for next year is expected to decline, as are the adjusted profits. And this would be due to tougher comparables, supply chain pressures, and cost headwinds, such as the ones that we'd discussed a little bit earlier, that impacted their profits from last year. No, that impacted their profits this year. Sorry. Right.
Right. Okay. So we, in this section, we're going to talk a bit about the long-term outlook, because we just talked about more the short term, like this year, and the outlook for 2022. However, ASOS does say that they are aiming to reach a 7 billion annual revenue in about 3 to 4 years, and the current revenue is 3.9 billion. And they're also aiming for a 4% EBIT margin. And the EBIT margin in 2021 was 4.9%. So if we assume that they get to 7 billion within about, let's say, 4 years, and you have an EBIT margin of 4%, that will equate to 280 million. And in full year 21, the EBIT was 190. So if you go from 190 this year to 280 in 4 years, that's a compound annual growth rate of 10%, which is, I mean, it's not great for ASOS because it's a high growth company, but it's not bad either. A company growing its EBIT at 10%, that's, a lot of companies would that would be great for them. So even though maybe the growth is a bit slower, like there's still growth left in the company, and also the company's focus is still the same. So they want to become a global retailer. And nothing has actually fundamentally changed. Like their outlook is still positive, and they're following in the same path as they did. So even though the short term is a bit disappointing, they're kind of staying on the same track for the long term. Right. So now that we talked about kind of the results for 2021, the outlook for 2022, and then also the more longer term outlook, we want to talk about what we're actually doing, because that's the most important thing. Like given these given the fact that we invested last month, and also given these kind of negative results, if you will, we need to figure out what we're going to do now. And I mean, what we've decided is that we're actually just going to hold tight for now. We're not going to do anything because we don't want to panic, and we want to see this kind of ride out a bit. And when you invest, like, some short to medium term negative news is expected. Like, it happens quite a lot. I mean, obviously you don't want it to happen 2 weeks after you invest, which is a bit shit, but it happens. And I think that the news of the CEO leaving is obviously bad news. Like, when you see a CEO leave, I mean, either he just left because he was upset, or he got fired, neither of which are good. And also that they don't have a new one lined up already is bad. But what I would say is that the CEO doesn't determine our thesis. Like, we look at it as a part of our thesis, but the main point is that we want to invest in a good company, in a good industry. And Warren Buffett has pointed this out, that you want to invest in a company that's so good that kind of anyone can run it, or, because even if you have a great CEO, but in a bad business, they're probably not going to be able to turn it around. So the CEO is important, but it's secondary to the more important things, I would say. So, and also, actually, I saw that he bought shares worth about £50,000 the day he left, or the day after. So even though either he quit or got kicked out, he still bought £50,000 worth of shares on the day he left, which is, a sign of confidence. So with everything, I mean, with that taken into account, like, the short term is obviously, we take that into account, but we're looking at the long term, so the next 5 to 10 years. And as we said, the outlook still seems to be relatively positive. But we did adjust our valuation a bit. I think in the last video we said the fair value is maybe like 40 or 43, something around there, if memory serves me. But given the negative news, we've adjusted it down a bit, and we found a range of between 28 to 34 pounds. And the reason for that is because now that there's been some negative news, we want to be very conservative this time, because if we are to invest more, we want to make sure that we come in at a way lower level. So it's better to be conservative now than to keep the valuation at the same points, just to kind of manage our expectations. And the last thing I think I would say is that I think if the share price maybe falls below 20, I mean, I don't know how likely that is, but then that would be 50% haircut from where we bought it, and that would be at a point where it'd be very cheap. Given that we already made a position and it's fallen about 25 to 30%, we're not really in a hurry to go further in. It's better to see where it develops from here. If it keeps going up, then good, then we'll just make back our money. But if it keeps going down, like, you might get so cheap that it's a good opportunity. But that's kind of the summary. I know a lot of people have been wondering about the results and the CEO, but we're holding tight. Nothing's changed much. We're keeping an eye on the situation, and just like not stressing, and just being patient. And as always, thank you for watching the video. Like and subscribe, follow us, all that sort of good stuff. And see you next time. Bye.